Hello everyone, my name is Noor Binti Salleh, metric card holder BB221610802. Today, I'm here to explain a fascinating topic that many people have heard but may not fully understand. The topic is the difference between Islamic bank financing and conventional bank loans. Although both provide ways to access funds, they operate on completely different principles. By the end of this video, you'll have a clear understanding of these differences, which may help you to make more informed financial decisions in the future. Let's start with a look at conventional bank loans. Traditional bank loans are widely used around the world, and they operate on a very straightforward principle. Here, a bank provides a borrower with a loan, and in return, the borrower agrees to pay back the principal amount along with interest. Interest is really key in conventional loans. For example, if you borrow $10,000 at a 5% interest rate, you'll end up repaying more than the $10,000 you borrowed because of this interest. This interest payment is how conventional banks make their profit. It's essentially a charge for the privilege of borrowing. There are few main types of conventional loans, like personal loans, mortgage, and business loans, all of which require interest payment. The interest rate can be either fixed, where it remains the same throughout the long term, or variable, where it fluctuates based on market condition. Either way, the bank's main source of revenue is the interest they charge on these loans. Now let's shift to the Islamic finance, which is grounded in Sharia or Islamic law. In Islamic finance, the concept of riba or interest is strictly prohibited. Islam views earning money from money, like interest on loans, as unethical. Instead, the system promotes transactions based on real assets, share risk, and ethical consideration. Islamic finance aims to ensure that both the lender and borrower share in the risk and reward in any investment, promoting fairness and social welfare. This means the bank doesn't simply lend you money and sit back to collect interest. Instead, they often take on a more active role in the financing process. To achieve these principles, Islamic banks use specific types of financing methods like avoid interest. Let's discuss on three most common forms, which is murabaha, ijara, and musyarakah. The first is murabaha, which known as cost plus financing. In a murabaha transaction, the bank purchases an asset that the customer wants. Then, instead of lending the customer cash, the bank sells the asset to the customer at a markup, which is agreed upon upfront. The customer repays this cost over time without interest. The markup is the bank's profit. For an example, if you wanted to buy a car, the Islamic bank will purchase the car first and then sell it to you at a higher price, which includes their profit. You will pay this amount in installments and no interest is involved. The second is ijara, which is known as leasing. Ijara is similar to a lease. The bank buys an asset and leases it to the customer. The customer makes rental payments for the assets, and in many cases, there is an option to buy the asset at the end of the lease period. For an example, in an Ijara home financing, the bank would buy the home and lease it to you. You would make monthly rental payments, and eventually, the ownership of the property might transfer to you if the terms allow it. The last form is musharaka, which is also known as partnerships. Musharaka is a partnership agreement where the bank and customer contribute funds toward a project, and they share the profits and losses according to their investment shares. This model is often used in business financing. For an example, let's say you want to start a business and you need financing. In a Musharaka model, the bank would contribute capital to your business as partner. If the business profits, both you and the bank earn based on your agreed shares. If there is a loss, both parties share it proportionally rather than the bank demanding interest or fees. A major difference between Islamic and conventional financing is how risk and profit are managed. In a conventional loan, the risk primarily falls on the borrower. The bank earns interest regardless of how the borrower's financial situation might change. But in Islamic finance, especially with partnership models like Musharaka, the bank and the borrower share both the risk and the rewards. If a business venture financed by the bank doesn't go well, the bank could also incur losses, encouraging banks to be more selective in their investments. Islamic finance also emphasizes ethical considerations. Investments that are harmful to society or deemed unethical, such as gambling or alcohol related businesses, are generally avoided. Islamic banks focus on ethical investments that support social welfare and community development. While Islamic finance may sound ideal but may not be available everywhere, and its products may have slightly different structures compared to conventional loans. For instance, some people may find murabaha arrangements less flexible than standard mortgage. However, for those seeking financing options that align with Islamic principles, these models provide a way to access funds without compromising on religious beliefs. To wrap up, the main difference between Islamic bank financing and conventional bank loans is the absence of interest in Islamic finance. Islamic banks use methods like profit sharing, leasing, and cost plus pricing to earn profits ethically while sharing risk with the borrower. This is very different from conventional banks, which primarily rely on interest as their income source. I hope this breakdown helped you clarify the differences between these two approaches. Thank you for watching.